Welcome. In this presentation, we will look at ITC key levels and zones using monthly and daily market structure. This is a no prediction, educational analysis focused purely on understanding price behavior, zones, and structure, not on forecasting or giving trading calls. Before we begin, a quick disclaimer. This presentation is for educational purposes only. It does not constitute investment advice. There are no buy, sell, or hold recommendations and no targets discussed. Markets involve risk, and this analysis is meant purely for learning how to read charts objectively. Here's what we'll cover today. First, we'll understand why key levels and zones matter. Then we'll look at the monthly structure, followed by the daily chart context. We'll identify important supply, demand, and acceptance zones, and finally summarize the current market state. Key levels are not single price points. They are zones where market activity clusters. Institutions don't operate at exact prices. They operate in ranges. That's why zones give us better context than precise support or resistance lines. This approach focuses on where participation happens, not predictions. Let's start with the monthly chart, which gives us the highest time frame context. ITC had a strong multi-year expansion phase. However, recent candles show loss of momentum and overlapping price action, indicating a transition from trend to consolidation or correction. This shift is important for understanding current behavior. On the monthly time frame, the 460 rupee to 475 rupee zone stands out as a major long-term supply area. This is where price previously stalled after the uptrend, showing strong selling interest. Another important zone is 390 rupee to 405 rupees, which has repeatedly acted as a strong rejection area. The 350 rupee to 365 rupee zone is an intermediate supply area. This zone sits in a low-volume region, which often leads to rejection rather than acceptance. Price has struggled to hold above this zone, making it an important structural reference. Now shifting to the daily chart, we see a sharp sell-off, followed by a reactive bounce. However, this bounce is occurring below previous structure levels, and momentum remains weak. This tells us the move is reactive, not impulsive. The most important zone on the daily chart is 315 rupee to 325 rupees. This is a high-volume acceptance zone, also known as a high-volume node. Here, buyers and sellers are in agreement on value, which usually leads to consolidation rather than trend. Below acceptance, 300 rupee to 305 rupees becomes a key demand reference. If price loses acceptance above this zone, volatility typically increases. Further down, 250 rupee to 275 rupees represents a long-term monthly demand base formed during earlier accumulation phases. Volume profile helps us understand where the market accepts price and where it rejects it. High-volume areas show agreement and balance. Low-volume areas often lead to faster moves and rejection. Right now, ITC is trading around accepted value, not exploring new territory. Putting it all together, on the long term, the structure is an uptrend under correction. On the medium term, the structure is neutral to weak. And in the short term, the market is in an auction or range-bound state. It's important to understand what the market is doing right now. The market is not trending. It is engaged in price discovery and value auction. This environment requires patience and context, not prediction. This type of analysis is meant to improve chart reading discipline. Always start with structure. Understand where acceptance and rejection occur, and avoid emotional or predictive decision making. 3 key takeaways. Zones matter more than exact prices. Acceptance is more important than forecasts. And structure should always come before opinion. To conclude, always remember, watch structure, not targets. Let the market show you behavior instead of forcing expectations. Thank you for watching. This is Thirumurugan Rajendran. See you in the next educational market structure session.